With me is Keith Pogson. Keith is Managing Partner for Financial Services at Ernst Young. They're launching their Eurozone Financial Services forecast today, and does it make grim reading, Keith?
Unfortunately, it probably does for most people. We think that Europe, in the Eurozone, GDP is going to probably come off 1–1.5% over the next year, followed by a bit of an uptick. We think the real problems are probably going to be in Central and Eastern Europe in the next year, though.
Is that because banks are exposed there and effectively they're having to pull back and sort out their balance sheets?
Absolutely. 75% of the money lent in the 6 major economies in Central and Eastern Europe, those loan decisions are made in Western European bank headquarters.
Well, is it because they've had this ridiculous policy of being allowed to borrow in, let's say, foreign currencies to purchase their houses, and therefore they're victim to interest rate swings abroad and then also the currency effect as well?
Well, that's part of it, but the bigger issue we see is liquidity problems in Western Europe, making sure that the banks need to shrink their balance sheets, and the regulators requiring more capital.
So we could see recessions in Central and Eastern Europe because of this, is that what you're saying? Well, as well as, of course, the main Eurozone too.
75% of lending, just think of a bad situation where 40 or 50% of that lending is not rolled over. Some investment banks predict that for a 1% cut in lending, that's a 40 basis point drop in GDP. So, worst case, you're looking at 12 to 15% drop in GDP across Central and Eastern Europe.
And with it, of course, comes not just the shrinking banks' balance sheets, but also the government's coffers also.
Absolutely.
As a result of that. So you turn to other measures, don't you, like the financial transaction tax, the so-called Tobin tax here as well.
The Tobin tax, yes.
To not just punish the financial services industry, but also to raise money here. But isn't it really your thinking here at Ernst Young that this could actually cost something like 116 billion euros, and wouldn't say that's how much it would leave a funding hole?
Yeah, we actually think this is not a clever idea. What we think is going to happen is that the markets will slow down, the impact of implying the tax will actually have a deleveraging impact on the financial markets, and we'll actually see a contraction in GDP. When you work out the normal tax impact on normal GDP and you work it all backwards, we think over the coming few years that's a $116 billion hole.
Yeah,
big hole.
Yeah, Keith, I want to get back to the retrenchment of these banks as they shore up their balance sheets, because we're certainly feeling it in this part of the world, aren't we? Walk us through that and the way that mechanism works.
Well, the banks in Europe are being required to increase capital and basically to hit the numbers, because they can't actually raise the liquidity, the equity in the European markets. They just have to shrink their balance sheets. To do that, they're going to have to curtail operations. So we're seeing them selling operations. We're seeing people looking at selling operations here in Asia. We're seeing them looking at selling operations in Europe. For Asia, that's kind of a positive story for Asian investors, because there's opportunities to buy things, assets that they wouldn't normally see.
But again, that liquidity is going, isn't it?
The liquidity is a requirement.
Yeah.
You need to have the money out there.
Okay, is that the primary reason why we saw Asian equities do so badly against, let's say, European ones? And, with the US, which looked like it was in an absolutely parlous state at the beginning of last year, it actually eked out a little bit of a gain.
I think that's exactly right. The US economy is self-sufficient in terms of liquidity and funding. The banking system is there is self-sufficient. And there is a strong pool of pension money that's been out for a long time. If you come and look at Asia, you look at Europe, Europe is being very contractionary in terms of liquidity, a lot of money being sucked home to basically put the finger in the dam of the issues and troubles that are in the Eurozone. That just means a big sucking problem on Asia. Asian markets have been more liquid, it's been easier to sell down in these markets, and hence we've seen the volatility flow through.
Okay, so what are the prospects this year? I mean, when does this actually come to an end, Keith?
Well, we think we've got another 12 months, and then, the back end of this coming year, we'll start to see an uptick as people, in Europe, we're getting towards the bottom. In the US, I think we're already turned the bottom of the upcycle. So here in Asia, it's a matter of getting that confidence, the liquidity back, the markets going. Behavioral economics are playing a big part of the game here.
Right.
People's emotions are really seeing the impact.
Well, that's
in
the
market.
thing. It becomes a self-fulfilling prophecy.
Absolutely.
And that's the danger. We get into this vicious cycle when people think things are going to get worse. They actually do. So you are a bit more concerned, a bit more positive about the US. So could the US actually come in and add some of the liquidity here when it starts to get back on its feet?
Well, I think the US process is going to be a slow grind. Maybe a little bit of liquidity. I think Asian markets are probably going to be a better source of liquidity. Asian investors continue to save, continue to invest. The pension worries are still here in Asia and going to be here for the foreseeable future. People need to invest in assets. So I think liquidity is going to come from this part of the world.
Keith, pleasure having you on the programme. Thank you so much for joining us.